Most traders, probably 3 out of 5 watching this right now, and yes, I'm talking to you, are approaching the markets completely at random. Random setups. Random strategies. Random risk management. Random execution. And here's the funny part, you feed the market random inputs, but somehow you expect consistent results. That's impossible. I'm about to show you how to build a trading plan so strong, it practically forces you to become profitable. By the end of this video, you'll know exactly how to build a trading plan that's designed around you. Because if you're using someone else's system to chase someone else's dream on someone else's timeline, you're not trading. You're pretending. And sooner or later, that gap will cost you. Not just money, but confidence, identity, peace. If you want to design your own personal trading plan right now, grab a pen and paper, because we're going to build it step by step together. Let's get started. We're going to build a trading plan so strong that long-term, losing becomes almost impossible. And when I say, impossible to lose, I'm not saying you'll never have a losing trade. Losing trades are part of the game. Every top trader experiences losses. The difference is having a plan that makes you consistently profitable over months and years, not just hoping each trade works out. It blows my mind how many beginner traders never focus on building a solid plan. But think about any serious profession where money and risk are involved, a plan is required. A detailed, thought-out plan. So why would trading be any different? Think about it. Entrepreneurs build business plans, they budget, plan marketing, hire employees, and strategize growth. You can't just open a business and expect it to magically succeed. Trading without a plan is exactly the same. Pilots have flight plans. They don't just hope the plane lands safely. They calculate altitude, routes, weather, everything. Trading without a plan is like flying blind. Engineers and architects design blueprints before constructing a building. Without it, the building would collapse. In trading, a lack of a plan can lead to emotional collapse, one bad trade after another. You see the pattern, every serious profession requires structure. Trading is no different. Your job isn't to trade. Your job is to follow a system. And that system is built through time, experience, and careful planning. Today, we're going to build one together. So, what goes into creating a trading plan? Where do you start? Trading isn't about guessing or chasing every opportunity you see. Random actions lead to random results, and random results don't make you profitable. Consistency is everything in trading. You're only as profitable as your ability to act consistently. To achieve that, you need consistent input, and consistent input comes from a clear plan. Step 1. Set clear trading goals. Most beginners don't fail because they're bad at charts. They fail because they're wandering with no destination. Think about it. More than 70% of new traders blow up their accounts. Not from lack of intelligence. Not because the market is rigged. But simply because they have no map. Saying, "I just want to make money," is as vague as walking into a gym and saying, "I just want to get fit." Okay, but fit how? Stronger? Leaner? By when? Without definition, you're not building a career. You're gambling. That's why you need specific, measurable goals. Forget about the fantasy lifestyle for now. Your goal shouldn't be a Lamborghini. It should be something you can actually track. Examples. Increase my account by 8 to 10% each month. Earn an additional $10,000 before year-end. These kinds of goals anchor you when the market gets crazy. Because clarity keeps you grounded. While fantasy leaves you lost. And here's something most traders overlook. Not every goal needs to be about profit. One of my most powerful goals ever was this. Complete 20 trades in a row without breaking my rules. That single challenge reshaped my entire discipline. So here's the hack. Write your goals down. Review them before every session. That simple habit will save you from chasing random setups you saw on Twitter or Discord. And if you want a framework, follow SMART goals. Specific, measurable, achievable, relevant, time-bound. So instead of the lazy line, "I want to be rich," say this: "I will grow my $500 account by 2% per week for the next 6 months." See the difference? That's not a dream. That's a plan. This is how you shift from wishful thinking to execution. This is how real traders grow. So I'll ask you right now. What's your trading goal? Not just to win, but to win with structure. Because if you skip this step, the market will chew you up and spit you out. Write it. Own it. Commit to it. Then, we move to step 2. Step 2, choose your trading style and schedule. Here's a harsh truth. Around 70% of traders quit within their first year. Not because they're dumb, but because they try to live inside a strategy that doesn't fit their life. Trading is not about copying someone else's routine. It's about building an approach that matches you. Your job, your habits, your personality. So let's break it down. There are 4 main trading styles. Scalping, lightning fast. In and out within seconds or minutes. Small moves, high focus, constant screen time. Perfect for adrenaline junkies, but not for most people. Day trading, still fast-paced, but more flexible. You open and close trades in the same day. Best if you can commit 3 to 5 hours during active sessions like London or New York. Swing trading, my favorite for beginners. You hold positions for days, maybe a week. It gives you time to think, plan, and avoid impulsive mistakes. Ideal if you've got a full-time job and only trade in the evenings. Position trading, the long game. Trades last months, even years. It's closer to investing, following global trends instead of intraday noise. So here's the real question. Can you sit in front of charts for hours every day? Or are you only free at night? Do you love quick decisions, or prefer patience and analysis? Your answers decide your style. And once you know your style, you need a schedule. "I'll trade when I feel like it" is a guaranteed path to failure. Instead, block out time and commit. Example, the London-New York overlap, 8 a.m. to 12 p.m. Eastern Standard Time, is one of the best windows for intraday trading. If you can't trade then, focus on higher time frames, like the 4H or daily charts. The rule is simple. Don't trade at random. A clear plan might look like this. I'm a swing trader. I review charts every morning at 8 a.m. I only enter trades during the London session. Write it down. Stick to it. Because the fastest way to burn out in trading is trying to do everything at. Step 3, choose your currency pairs. So, what do you actually trade in Forex? There are over 60 different currency pairs, indices like the Dow Jones, Nasdaq, and S&P, gold and silver, each with its own behavior and suitable trading session, and more. But the truth is, you really only need 2 pairs. Each currency pair has its own personality, some move slowly, while others are fast and volatile. By following them daily, you can learn their personality. Focus is key, master 2 pairs before adding more. Trade less, but trade accurately and confidently. Trading isn't about speed, precise execution is what matters. Choose your style, schedule, and pairs to sharpen your skills. A solid plan could look like this. I only trade Nasdaq and Dow Jones. I only enter trades during the New York session. I only take setups that match my strategy. Now, let's move on to how to place your very first trade the right way. Step 4. Define your trading strategy, entries, and exits. This is the stage where most beginners go wrong. The issue isn't whether they have a strategy, it's whether they actually execute one. A lot of new traders hear someone online say, just buy the sweep liquidity, and think that's a trading plan. It's not. A real strategy has rules. It's written, repeatable, and mechanical. If your entry isn't clear enough to follow like a recipe, you're not trading, you're guessing. Here's an example of a simple entry rule. I only buy when the price reaches a discount, an MSS is formed, and I can enter on a breaker block or CSD within an FVG. That's it. No emotions. No improvising. If all three conditions aren't met, you don't trade. That's how discipline works. You're not searching for setups, you're waiting for your checklist to be satisfied. And that checklist, that's your edge. Without it, you'll find yourself entering late, exiting early, and constantly asking why nothing seems to work. The same applies to exits. If you don't know when to get out, the market will decide for you, and trust me, it won't end well. Every trade needs a take profit and a stop loss. Before you even click buy, you should know both numbers. Think of it this way. If price hits X, I take profit. If price hits Y, I accept the loss and move on. A clean take profit might be the next resistance level. A smart stop loss might be just below a key support zone. Both decisions should be based on the chart, not on your emotions in the heat of the moment. Now, some traders rely only on technical tools like FVG, order block, or even moving averages or RSI. Others focus on fundamentals like economic news, interest rate announcements, or NFP Fridays. Both approaches can work, the key is to be consistent. For example, your plan might say, I don't trade 30 minutes before or after major news events. That's clear. That's strategic. And it belongs in writing. Because here's the truth, if your entry and exit rules aren't written down, they don't exist. And if they don't exist, you're just one bad trade away from blowing up your account. Step 5. Set your risk and money management rules. This is the dividing line between traders who survive and traders who quit. Risk management isn't flashy, but it's what keeps you in the game when the market hits back. Rule 1. Never risk more than 1% of your account on a single trade. If your account is $500, that means risking only $5 per trade. It sounds tiny, but that's exactly how professionals stay in the game long enough to build consistent results. Rule 2. Always use a stop loss. No exceptions. Place it at a logical spot, not where your emotions tell you. If you're buying from support, your stop goes just below that support. If you're selling at resistance, your stop goes just above it. Stops should be based on market structure, not guesswork. Rule 3. Know your risk-to-reward ratio. This tells you how much you're trying to earn compared to what you're risking. For example, if you risk $50, you should aim to make $100 or $150. That's a 1-to-2 or 1-to-3 ratio. Why is this so powerful? Because you don't need to win every trade. Even if you only win 4 out of 10, solid risk-to-reward math keeps you profitable. Rule 4. Position sizing. This is how big your trade actually is. Use a calculator, don't guess. Enter your account size, your stop-loss distance in pips, and your risk percentage. The calculator will tell you exactly how many lots or microlots to use. Beginners blow accounts by going too big, too fast. Don't be that trader. Rule 5. Set a weekly risk cap. For example, if you lose 3 trades in a row or drop 5% in a week, stop trading. Step back. Review. Take a breath. No revenge trades. No chasing. Your job is survival, staying alive long enough to catch the next high-probability setup. If you only remember one thing from this step, make it this: you don't need a perfect win rate, you need rules. With a clear strategy and disciplined risk control, you stop gambling and start executing like a real trader. Step 6. Build your trading routine. Your trading plan is only as strong as the habits you follow every day. Good routines make you money. Bad ones cost you money. Most traders don't fail because their strategy is terrible, they fail because their routine is sloppy. So let's create one that keeps you sharp. Start each day by checking the economic calendar. Go to a site like Forex Factory or MyFXBook and see what news events are scheduled, interest rate announcements, job reports, CPI numbers. These can cause huge volatility, so you need to plan around them. A simple routine might say, check the calendar every morning, and avoid trading during high-impact news. Next, mark your charts. Pick a consistent time, maybe 6:30 a.m. before work, or 8 p.m. when things are quiet. Open TradingView, load your pairs, and mark key levels, FVG, liquidity, order block, supply, and demand. Use the same tools the same way every day. You're building a checklist for your brain, and that's how you create consistency. Personally, I keep it simple. Is price trending or ranging? Are we reacting to a key level or breaking through one? Those two questions alone tell me whether it's worth trading or whether I should wait. And here's the most underrated tool in trading, your journal. If you don't log your trades, you're flying blind. Write down every trade, entry, exit, win or loss, and most importantly, why you took it and how you felt. Were you confident? Were you rushed? That's gold. At the end of each week, review. Not just the results, but the patterns. Maybe you lose money every Friday afternoon. Maybe you win more when you wait for 3 confluences. These clues make you better faster. Your routine doesn't need to be complicated. It can be 5 bullets long. Check the news. Mark the charts. Wait for the setup. Take the trade. Log it in the journal. That's enough to trade like a pro. Step 7. Test and refine your plan. This is the final step, the step that separates dreamers from doers. You don't finish a plan and go live on Monday. You test it first. Start with backtesting. On TradingView, scroll back in time, find where your strategy would give a signal, and mark the trade. Then play it forward and see what happens. No emotions, just data. Do this for 20, 30, even 50 trades. Track the results. If you're winning more than you're losing, and your average win is bigger than your average loss, that's a green light. If not, adjust. Maybe your stop is too tight. Maybe your entries are early. Refine until it works on paper. Next, forward testing. That means trading the plan on a demo account in real time. No real money, but real action. This tests your discipline. Can you stick to the plan when the market moves fast? Can you wait patiently for setups? If not, you're not ready. If you can, you're getting closer. Run it for a few weeks before going live. And here's the secret most people miss: your plan is never finished. It's a living document. You grow, the market changes, and your plan evolves with it. Every month, review your journal, update one rule at a time, test it again, and keep refining. That's how your plan transforms from decent to dangerous. Most beginners spend years chasing a secret strategy. But the real edge is this process: plan, test, refine. That's what produces results. Look at what you've built. Clear goals. A trading style that fits your life. A focused set of pairs. Defined entries and exits. Risk management rules. A daily routine. A system to test and improve. That's not guesswork, that's structure. And structure equals control. Most traders lose because they wing it. You won't. From now on, every trade has a purpose, and every mistake has a plan to fix it. If you found value in this, make sure to subscribe, and I'll see you in the next one. Love you all.